That's called the standalone principle. Some costs pop up sometimes. If I looked at this 11th bakery 10 years ago and evaluated it and decided not to do it and spent some money doing that, that's considered a sunk cost. So forget about those sunk costs. We learned that in economics class. These costs have already been incurred 10 years ago. Just forget about it, as we used to say in Brooklyn. Opportunity cost, however, what valuable alternatives are given up if we take on this project? I want to include opportunity cost. For instance, what's the opportunity cost of having a finance meeting at 8 a.m.? You got to include that in the value of the project, in this case being finance class. Erosion may happen where you have a new project, cash flows of the new project come at the expense of an existing project. Let's say the Ford Expedition, when it came out first, was eroding the sales of the very popular Ford Explorer. I want to take that into account. Okay, I want to take into account erosion. We do not ignore erosion. Very important concept. Normally, a project will require that we invest in some working capital. We all know working capital from Chapter 2. It's current assets from the balance sheet minus current liabilities from the balance sheet. In addition to the long-term assets, which we normally include and we don't even think twice about, but we also have to include working capital, especially if there's a cash outflow at time zero. You want to try and recapture that at the end of the project when you close the project down. So don't include financing costs, but do include net working capital. And we want to look at, we're always interested in after-tax cash flows when we do these analyses.